Well, hope you're having a great summer. There's been a lot to think about in the stock market, not just those macro stories or the earnings calendar, but just the fact that we've seen equities at all-time highs. Joining us now for some portfolio chat, Sadiq Adatia, Chief Investment Officer at BMO Global Asset Management. Good to see you.
Thanks for having me.
A lot of days off this summer or not so much in 2025?
Yeah, a little bit of time off, but obviously a lot to digest in markets for sure.
Yeah, so what are you thinking about right now?
Yeah, I think the first thing is, where do we think markets are actually at given the fundamentals? So take out some of the noise, take out, we still have some things uncertain on the tariffs front. But how do we look at the second half of this year? And we still see markets go higher from here, but as you're seeing in August, the volatility is going to pick up a little bit more now. And I think that will continue probably into September, where we might then all of a sudden in Q4 start to get that rally back again as we end off the year. I think the earnings are still good, and I think that's supporting the valuations and why I think markets go higher from here. We have a little bit more clarity, at least on some of the tariff side, even though they're higher than what we were initially looking at in that front. But I think we still have to keep the door open to these ad hoc tariffs popping up, not just from an export business, but even from a potentially strategic relationship perspective from the U.S. side of things, like oil, good example with Russia.
Yeah, and correct me if I'm wrong, but I feel like in our recent conversations, you've generally been leaning into U.S. equities, like not fighting that tape. Is that correct?
Yeah, we were riding the wave. I think the momentum, we're staying on that momentum curve. We think the consumers are still going to be resilient, even though we have seen some cracks there. I think until we see a significant drop off in the consumer spending, a bit of worry on that front, or earnings or outlooks from the earnings side looking a lot more cautious, I think we still think the U.S. leads the charge back here in the second half of the year, and we want to ride that momentum going through. Okay,
and I'm looking like May was a positive month for the S&P, June was a positive month for the S&P, July was a positive month for the S&P. Here's my anecdotal take from people who are very smart and come and talk with us. There's a handful that say tech stocks are too stretched, sell them. Most people say we want to have exposure to growth, but also be ready for a possible sell-off. And as part of that sell-off, I almost feel like people are getting ready to buy the dip. That's sort of my non-scientific poll of guests recently. Let's start with, do you think people should anticipate that you actually could see a pullback from these all-time highs with those U.S. stocks?
Yeah, I think you should see some sort of pullback. I don't think it's going to be a meaningful one, though, but I do think you will see some pullback heading to these next couple of months of volatility. Maybe sell off the news of earnings as an example. We have the NVIDIA earnings at the end of the month.
Yeah.
Right? That's going to be an important one. There's potential we could see some selling right after that as a result of that. However, I don't think it's going to be anything meaningful unless we have a massive disappointment on the earnings side. And again, we're not expecting that. But unless you have a massive disappointment, that could cause markets to pull back significantly. But I think right now, with the tariff situation, it is livable and able to be absorbed partially by companies, partially passed off to the consumer, which will have impact on earnings, but not dramatically at this point in time. So I think we can justify markets going higher from here as a result of that. And the Mag 7, excluding maybe Tesla as an example, have still strong earnings, still have good momentum, still should be the ones that have the best earnings that can, again, move markets higher from there on the U.S. side.
You and I have both observed a lot of different market cycles, so you know that sentiment can change sizably. But I'm going to park that point for a second just to come back to the idea of what is the alternative. If your money is not in stocks or sprinkled into gold or whatever people are doing with it right now, in an environment where there still seems to be sort of like a trickle of inflation, wages are not rising rapidly. There's a new generation of investors. I do a lot of digital stuff too, and I see them. They are active, they are entrepreneurial, and they're trying to make money. So I feel like that's a force in the world that cannot be ignored. What's your take?
Yeah, I agree with you on that. I mean, we're bullish both on equities and bonds today, actually. So we really don't want to own any cash at this moment in time. We think the trigger for interest rates could help on the bond side. We think it also will help, lift a little bit on the equity side still. But when we look through where, people are looking at, the future growth, where the CapEx spending is going, it's still tied to a lot of things that are tied to growing the U.S. economy through AI, through these big, large cap companies. And so there is no need to fight that momentum. I think you want to own that. Beginning of the year, people thought this was going to die off. You can see the second half being completely a different story post liberation. The only concern you put, I think, there is the valuation too rich? And there's a possibility to that. But the question is, does the valuation go into the earnings? I mean, go back to NVIDIA, a good example. Looked very rich 2 years ago. Now look actually dirt cheap when you look at it, what the earnings actually turned out to be. So it does depend.
And the earnings projection is sort of constantly being calculated into the valuation. The other thing I find very interesting, like we had a chat this week with someone who said, look at the S&P 480, look at everything outside of those top 20 names, which kind of gets us into sort of like a value versus growth dialogue. It is complicated for some of those companies to just get attention, like full stop attention, when we see these brand logos for these top stocks in the S&P constantly. They also happen to be largely technology companies, which is the way people interact with like their phone and all that kind of stuff. How do you feel about that? We've had the value versus growth story even with the TSX over a long time. But like I think a lot of sound investors who watch BNN Bloomberg are looking for good deals in the market that they can put into their portfolio for the long term. What's your take?
Yeah, I think you do have to do that for sure. And I think we like financials, we like communication services as well. But technology does spread across all sectors right now. And so you don't have to necessarily be just in the Mag 7. You can be spread across other areas where you're going to see the benefits of AI or the benefits of, again, higher technology spend to improve margins, to improve profitability, and maybe drive market share. And so when I look at the financials, I think they were really beaten up quite a bit. We're seeing life in them again. We're very optimistic about this going forward. So there are other areas that you should be actually diversifying within still in the U.S. space and not just tech-driven. I think the sell-off in the tech that we saw earlier in the year gave us a buying opportunity to jump back into it.
Got a lot of it just sort of sucked up a lot of attention.
That's exactly right. So I think you have to be very careful about what you own, but I do think you need to be diversified and spread across the lower valuation, slightly different, style of investing when it comes to just growth in tech. To have that diversification, and I think that's going to help diversify the bumps that we're going to see over the next couple of months.
And then what's the view on bonds? You said have some bonds.
Yeah, we like bonds. I think they've quietly done better than cash this year. They're actually going to have some upside potential here with rates if they start picking up in September, being cut. I think as you're talking about, the valuations.
You can lock in yields before the rates go down, basically?
Yeah, and then the rate cut environment will actually help boost returns on the bond market and have money start moving back into bonds a little bit as well. Because people have kind of sat there and say, I don't know when rates are going to go up. I don't know what my bond's going to give me in this environment. So this, potentially, along with the fact that we've had a great run in the equity markets. And so even though we think markets go higher from here, I'm sure there's a lot of people out there who are sitting on cash that want to step in. And bonds is a good way to first step in to get some exposure. But also as people start to look to readjust their portfolios, people might move into the bond market where before their alternative was cash and they didn't want to do that. So, we do think both cash and bonds, cash and equities can actually, bonds and equities can actually give us, an upside, positive momentum here.
But the money under the mattress idea just doesn't work unless people get super spooked and, things start to turn strongly.
But even if you get super spooked, right, if let's say the economy falters tremendously, rate cuts will happen a lot faster. That likely means inflation is maybe not, as high as people are expecting. That to me shifts bonds momentum, stronger from here as well. So again, to me, this is not where I want to be sitting in cash. Our house view is definitely tilted towards equities, but also towards bonds as well.
Okay, Sadiq, thanks a lot. Appreciate it. Sadiq Adatia joining us from BMO Asset Management.